Obie and Josh, thank you so much for agreeing to this interview review of your second quarter earnings. Before we get going, I want to give a disclosure that I am not an employee. I am not a paid advisor of Grown Rogue, outside of occasionally getting some Grown Rogue product, which I haven't gotten in a while, by the way. I am not compensated by the company in any way, shape, or form. I'm an independent investor. My funds, across all my funds, I'm the largest investor in the company. I ask that anyone who listens to this, please do your own due diligence. Please do not rely on what I'm saying to make an investment decision. And please know that I am wrong often. And to start this video out, I am going to give a little mea culpa on Grown Rogue and I was just telling Obie and Josh this, my greatest strength is that I get very excited about things, and my greatest weakness is I also get very excited about things. And I wanted to give a mea culpa specifically on Grown Rogue because while I still very much believe in the company, what it's doing, and the long-term trajectory, um, I have been wrong on how cash flow would flow through the financials this year. And it's delayed. We're going to get into that. We're going to get into the mechanics of how things are working. And this is further evidence of why you should do your own due diligence. Make sure you understand your story. I have continued to buy the stock because I believe in what they're building and I believe in the long term. And we're going to get into unit level economics and things like that and explain why it's coming. But I just wanted to make that disclosure first before we started. And before we get to the interview, I want to discuss why Grown Rogue. I believe that Grown Rogue has figured out a way and has one of the few reproducible models in cannabis, and specifically in cannabis cultivation. What do I mean by that? If an investor decides to say, hey, I want to put 5, 10, $100 million to work in a cannabis company, of the publicly traded cannabis companies I know, you have no idea what they're going to do with that money. They have no idea. They'll probably pay down some debt and build up cash on their balance sheet. But there's no like, oh, well, we have this model where we're going to do this in this state and this, and we just reproduce it along. That doesn't really exist in cannabis. There's a lot of free for all, spaghetti on a wall. We're entering this market. Oh, we're exiting it. What Grown Rogue has been able to do is figure out how to be the low cost producer of indoor craft flower. And what I believe they figured out is kind of like a box where they can like 50,000 square feet, maybe potentially in the future a little more, where they can pump out 12,000 pounds of craft indoor flower. It is hyper efficient, and they are doing it at costs that when you reverse engineer an apples to apples comparison, I believe that they can compete with California greenhouse flower, which frankly shouldn't be possible, but is thanks to dramatic improvements in yield, selling out all of their product. And as evidence of that, they break out the unit level economics. And there's only one other company that does this, and that's Glasshouse, where you can see what their cost is in every state, what their fully loaded cost is. And I believe they have a reproducible model, and that even in the most depressed environments of extreme price compression, they're still profitable. And a great example is just Michigan, where pricing has fallen 80%, and the company's still producing about $3.5 to $4 million of EBITDA, and that's at $800 flower. And we just had a former cannabis executive, Jamie Mendola, with Air Wellness, come out, and he was on a podcast and basically saying that below $800 of COGS, not fully loaded costs, very few people make money. And when you revert, it's really important to reverse engineer what he's saying, if you were to do an apples to apples comparison of what he's saying MSOs need to make money, they need $1,000 flower. And I think that this is a very important point. I know of no other industry, commodity industry, where investors do not ask and demand the question of what is the cost of producing that commodity. Only in cannabis do people look the other way and say, oh, I don't care about that cost, or I don't need to know that. It's one of the reasons why I've profiled Glasshouse so many times, and I'm so invested in Grown Rogue, is they are actually showing you their unit level economics. And that's how you can develop a reproducible model. And I think few people are paying attention to this. And so you can kind of map out what the future is. And the future can be delayed. It can take time, but the future is still the future. And you can still map out what those unit level economics will produce. So anyway, that's my disclosures and discussion. Obie and Josh, thank you.
Yeah, thanks, Aaron. Thanks for having us. We're excited.
I want to start with the metrics, and I wanted to start with that the last 2 quarters, you have been sharing total flower harvested, cost per pound, A and B flower yield. For those that are not familiar with cannabis, or you're the only company that's basically showing flower yield, A and B flower. Why is that important? Why should investors care? And why aren't other companies sharing this info?
It's a good start to the conversation. We made a conscious effort. Part of this was Josh coming on board with our organization officially to provide better disclosure and communication, mostly around how we manage our business. And these are pieces of information that we've been tracking and dialing in for 4 or 5 years. And we just thought it was a good opportunity to educate, the investor kind of community around how we focus on the business and what we find important. The reason we picked those categories is it's really just the fundamental, kind of foundation of our business. I mean, we've said for a long time, like whole flower is what we're in the business of. We don't talk about biomass. That's kind of like we look at trim as a byproduct. We're starting to use that product in some more of the products that we're putting out, some of the SKUs. I'll get to that a little bit as we talk about Oregon and kind of the whole cow mentality. So when we talk about A and B flower, we are talking about a saleable product, right? There's really kind of 4 products that come out and 3 products that come out of a cultivation. There's A flower, which is your biggest buds. They get the highest value. There's B flower, which is essentially the same quality of product, except it's a little bit smaller. And then you have trim. We don't look at trim as a core part of our business. And so we like to separate A and B flower kind of as a separate, way that we track things. We prioritized ASP on A flower. Obviously, we have a ton of SKUs. There's variability even in the genetics for the A flower we thought an average ASP for A flower was kind of an important parameter around just mostly a guideline for people to see how that's trending within our markets. And then obviously costs, we went back and forth on this before we set it up, but, fully loaded costs in our markets, not just taking COGS. And so one big differential is when Grown Rogue reports our fully loaded costs, that's selling cost, that's administrative cost inside of our markets. It's not just your typical COGS, which is cost of goods sold, which would be like, power, labor, materials. We think if we just use that portion of it, we're probably down, sub $300. If we included all the biomass in our calculation, we're probably even well below that. And no other company does it, probably because it creates questions. Like we even got questions on our last disclosure of, in the Q2 earnings. Effectively, we don't understand how this translates directly back to your financials. And it's never going to be perfect. We'll try and iterate on that, make it a little bit more clear. But again, the way we look at our business, what we track, how we look at our success and, the things that we need to improve on for the controllables, those are the most important kind of components of what we want to put out.
And so if I understand correctly, you have the highest selling product, which is A flower, and you want to maximize that because the
Correct.
price differential between the A and B is decent,
Sometimes as
but
much
it's
as
real,
2x.
and
Yep.
sometimes as much as 2x. Okay, that's helpful. But then it's really massive over trim, right? Because could you give us an example of what's the price differential of, I'm not going to hold you to what exactly it is today, but what's the differences between A, B, and trim?
It's, I mean, the spread in Michigan's tighter, so B is tighter to the A. I would say A flower is 10x what trim is, maybe more.
Gotcha. So you
In terms
really
of
want to
value.
maximize
Correct.
that.
And production methodology will drive that. I mean, we could show, and I've thought about doing this just because there's, everyone's like, oh, and you talked about Glasshouse earlier, great company, like a lot of respect for those guys, but they report on a biomass denominator, right? It's like comparing apples and oranges. And
Yeah.
so, and for instance, in indoor, we have much less trim as a byproduct than we do outdoor. Like our outdoor product, like much more trim. I don't know what the trim ratio is on different production methods. But again, we're focused on the products we grow. What's the cost, based upon, like, we're a flower producer, like we're not a biomass maker. But I said on the conference call, I bet for indoor, on a COGS basis, including trim, we're sub $200 a pound.
Gotcha. And yes, no, that's very helpful.
Can I jump in real quick just with an anecdote?
George.
Because I think for me, in I'll call it my more holistic lens, not the operator, when we got to know Grown Rogue back in 2021, what really crystallized for me personally, and you'll hear me say this because I feel like when I'm having cannabis conversations, it's maybe like every 35 sentences for me that I bring in the efficient production of quality flower. A flower is the engine of the industry. You see it in these mature markets, and it was really this dynamic in Oregon that made me realize that what makes or breaks a company like Grown Rogue, when you get to this dynamic where your A flower is going for, back then, call it $800 a pound, and your B flower is going for $400, $500 a pound, and your trim is almost worthless, that the maximization of your A flower production is what keeps you in business. And ultimately, you start from that mature market view and you layer it forward. And it's also the productivity of that A flower production that gives you better biomass for your infused products. It gives you better feedstock for that whole system. And so when I talk about A flower production being the engine of the industry, it really ties back to that core dynamic. And so, as Obie referenced, we're sharing these metrics because it's how we look at the business. Now, our dashboard is significantly more detailed than that, and there are other layers that come in, but we pick that so that we can share how we make decisions and what we're looking for and what we're driving toward. And I think that's really the core.
And then sometimes there's just like a lag, right? Because in a quarter you could produce a bunch of cannabis, but it doesn't mean you're selling that cannabis in that quarter. And you could have either a rise or fall in yield. I saw this at Glasshouse, is that there's often a lag of a quarter when you see those numbers and they flow through the financials. And so this is just one observation that I saw and we even talked about this on the last call, is there was a dip in efficiency, a dip in A yield in Michigan in Q1, but you saw the impact in Q2. And so we may hopefully see a rebound because in Q2, all the productivity numbers went up from a harvesting and kind of production. But so that's just like another data point of how you can use is what you see as COGS may not flow through until the next quarter or so, right? Is that the right way to think about it?
Yeah, you have about a 45-day lag period from harvest to when it's available for sale. You have to dry it, you cure it, you got to trim it, you got to package it, you got to test it, you got to get it into your inventory. And so, but we sell our inventory pretty quickly. our target's like it's 30 to 45 days between when you harvest to when you sell.
Is there any? Yeah, go ahead. Sorry.
Just the last thing. We're one of the few companies that discloses, I think, this level of detail, right? We disclose state level, unit level economics. The last company we saw that really got this granular was Verano, and it was very awesome, right? You guys can actually see how they were delivering in their markets. They ended up pulling that disclosure. My suspicion is because they got, beat up for it. And there was a lot of questions around, well, and they got all this detail down to like, well, what about this market? Why isn't that performing? Why is that going down? And I think that functionally, I think that's one of the problems with the industry is they're like these black boxes of what are the companies doing? How are they performing? Like, is one market propping up the other? Like, where are you hiding stuff? And I think for Grown Rogue, transparency is a big part of what we want to do. And so you can expect this from us going forward. And we realize there's going to be questions. There's going to be potentially some inconsistencies. We'll do our best to address those. But we think as much disclosure for investors as possible to make good decisions is the right way to approach, our business in this sector.
And I think people are also, there's another apples to oranges comparison when you're comparing what companies are doing selling cannabis for $1,800 a pound in Illinois, $2,500 a pound in New Jersey and other markets, Maryland, Florida, et cetera. And they're comparing it to a Grown Rogue that's competing with $600 flower in Oregon, $800 flower in Michigan. And as you go to those markets, it's going to be, you can already start to see you disclose information on New Jersey. We'll get into that. You have a 50% EBITDA margin and you're not even fully ramped up in New Jersey yet. And so it's just interesting. So here's a question that I have, and this goes to my earlier point of my, like, hey, I thought there's going to be all this great cash flow. It's going to be Obie, you and I are going to be swimming in it. It's going to be great. New Jersey's so awesome. When do you think we'll start to see these unit level economics play out in the consolidated financials? If you could, because part has been masked, you've seen tremendous cost control. And so just to give you just the listener some feedback of what's so stunning is Grown Rogue announced a $369 fully loaded cost for Michigan indoor flower. It's a stunning number. When I first got excited about Grown Rogue, it was like, hey, they're sub 600. It's like 500. To get to 369 is just a very stunning number for a fully loaded cost that includes sales and like packaging, all that stuff. But Michigan has seen like a 25% price correction in the last year. And New Jersey has been a little slower than expected. So we see this tremendous cost control. We see the unit level economics, but they're not playing through the financials yet. And what would you say to investors just about that?
Yeah, I think Josh would probably give some more technical details. He understands there's more versed in some of these things. Oregon and Michigan have price pressure, and we're maintaining pretty good margin. But again, you have reduction in top line revenue, even if you remain better cost control. Like margins stays the same, but total dollar shrinks. We expect pricing to recover in these markets. These are cyclical. We've seen this play out several times, and we're seeing pretty good stability in Michigan. I know we'll get to Michigan questions, I'm sure, later, so I won't belabor that. And then we have to remember, Jersey's not consolidated. And so we're reporting that on a pro forma basis. It's still in the early phases of ramp. Jersey's been a more difficult market than anticipated. We're used to markets where high price would relate to undersupply. It's being propped up in that market because, there's just a demand for, maintaining profits and revenues inside of that state with some of the operators that are already there. And so we're having to earn a little bit more. Doesn't change the core concept of who we are and what we're trying to do. It's just going to, we're having to earn the customer, work to get on the shelf, justify and kind of explain our value proposition. And so while we expect it to go faster, we're very pleased when you step back and look at the progress we've made. Very happy with the ramp. You talk to people in that market who have watched Grown Rogue progress. And when you're in like at the retail level, they're like, who is this new company that's coming here and gaining all this market share? And so we are doing a good job of that because it's very entrenched. I mean, Jersey by itself is a mature market. It's not mature pricing like you see in Oregon and Michigan, but it's been in adult use for 3 or 4 years. There is entrenched retail, entrenched brands. So we're working on, winning that and converting those folks. And so because we're not consolidating, it's not in the face of the financials. We believe, and I think Andrew talked about this on our conference call, when we're doing our gap conversion this year, under gap rules, we should be able to consolidate Jersey, and then Jersey will flow through the face of the financials. And so it'll just be a little bit easier for investors to understand rather than reporting like the pro forma that we've been putting out the last 2 quarters.
And when is that conversion to gap happen? Will it be as of Q4, or will that be the end of the year? It would be an end of the year kind of conversion, or what's the timing?
Yeah, it's interesting. It's a question I should ask internally as well. I mean, I know our year end 2025 will have the conversion for our audit. What I don't know is if we will be done to report fourth quarter under that, or whether we will just be reporting the full year when we get to audited financials, because sometimes there can be a gap between those two things. But I think by and large, it'll be that conversion to gap in the fourth quarter for the year. And I think that, the technical detail that I think just to kind of put it all together is right now the way Jersey works from a cash flow standpoint. So on the P&L side, we are reporting the pro forma results. You referenced the EBITDA margin. You can see what that state's doing kind of on a standalone basis from a P&L standpoint. But when it comes to the cash flow statement, because it's not consolidated, it shows up. The cash that gets produced in that state shows up actually usually below the operating cash flow line and financing, because we did lend money into that entity that the loans get paid back first. There's a capital priority attached to it. So it's got great structural integrity, but it does not give it the kind of the consolidated financial statement view that most would prefer.
Got it. Before we go to New Jersey, let's go state by state. And let's start with Oregon. Oregon pricing, which was crazy, is seeing it go down to like $617. One is, can you give an overall update in Oregon? Are these the lowest prices Oregon's ever seen, or have they gone lower before? And what are your expectations around like pricing and how Oregon's doing?
Yeah, Oregon feels pretty stable for some reason. Like I know pricing's down, but again, like our cost control has gotten better. We have the outdoor business there that helps, kind of navigate through some of the, again, indoor A pricing that, is kind of the reporting metric. We've launched some new products in Oregon that have been kind of exciting with our pre-roll business. And, we just put infused pre-rolls into the market this last quarter. So we're, starting to see the fruits of that effort. We're working on the next product that we're going to put into that state, but it's definitely on average, I think, the lowest kind of sustained pricing we've seen in Oregon. But again, it's kind of messy, right? In terms of like the last big kind of pain point was like 2021, 2022, when, we saw another kind of massive price compression. And that was when we were scaling, like we built a new farm, we acquired the acreage asset, we were trying to bring all this more capacity. We weren't even separate in like A's and B's before that time period. It was just all one blended bag. And so, there was a lot of kind of commotion as we were building the scaled business in Oregon during that time frame. So I feel like pricing is the most challenging we've seen. That's coupled with a much more robust and strong operating team. But it actually doesn't feel as painful as it did in 21. If it's, if you can believe that, like, even though pricing's lower, like the confidence in our business and just how entrenched we are with, just the way we go about our business here, just seems very, very stable. And then these things come in cycles. We had the big one when kind of, the first adult use crash happened in like 17 when we were going public. That was always fun trying to convince the Canadian bankers that, we still had a good business. And, it's not to get off on a tangent, but like, we got told, oh, you're awful back then, just because of no one really understood like the core components of how this industry is going to work. And we were telling people like, wait till Canada goes through this, and Canada's gone through their own kind of, reconciliation, whatever you want to call it. But so that was the first one. Prices came back up. We all thought we were geniuses. This is amazing. I was just explaining to a guy this morning, like, high prices create more entrants. More entrants create more supply. More supply creates lower prices. Lower prices creates more distress. That creates people going out of business. That lowers supply. Prices go back up. It's just this cycle that goes back and forth. And we're very comfortable that Oregon will have a recovery. But this is, again, what we were built for. We've said this for years, and it's easy to say it when pricing's decent and be like, oh yeah, we're prepared, we're built. When you're in the middle of it, sometimes you're like, because it still is awful, but it's what we were built for. And so Oregon and Michigan actually are not causing me, I want them to be higher because I want that contribution. But nothing of our kind of philosophy and how we're approaching this industry has changed. And we expect kind of this movement and recovery. I think the more areas that we're really focused on, right, in terms of, just getting outside the Oregon topic specifically is, how do we continue to empower our team? How do we bring the right leadership and talent in there to support the growth? Are we making the right investments in our growth? It's one thing to just sit there, and we did this for a couple of years, right? We were showing people Grown Rogue can generate cash. But we're also now in this, there's opportunity in front of us. Josh will get into some of the distress. Like we think about ramping in Jersey. We're probably actually not spending enough in Jersey. We should probably be spending more aggressively on marketing, branding, outreach, right? Like we're reinvesting to build the next platform of Grown Rogue, going from 2 states to 5, 6, 7, 8, whatever that is. And that takes investment. And there's going to be short-term pain, but like you have to invest into that future. And so talent, more marketing, better support, chasing a few more things like Minnesota. We'll get to Minnesota in a little bit. The distress that we're working on, like all these things take investment into the future. And I'm very confident that the choices we're making are for the best interest of, not only our business, but our shareholders at large. I know you're the largest shareholder at this point, which congrats. But Sarah and I are still the second largest shareholder, haven't sold a share. Like the commitment we have long-term to this business has not changed.
Yeah, no, thank you for that. When I look at both Oregon and Michigan, one thing I was thinking about, I don't know if you've thought about this, is when I think about how 280E may help, I think about what's the most distressed part of the cannabis system. And it's actually I think the retailers in the unlimited license states. Have you put any thought about what benefit there might be to the ecosystem in Oregon or Michigan if you do get 280E relief? I thought about it in California. I have some investments in California cannabis companies, and one of the biggest pain points for anyone operating in the legal cannabis space is selling to a distressed dispensary system. I'm just curious what your thoughts are.
Yeah, I don't give that a lot of thought. Most people aren't paying 288 tax anyway. People have been asking about this more. Now we're getting like reform and rescheduling kind of noise that's coming in, which is super exciting. But, like a year and a half, 2 years ago, everyone was talking about 280 going away because that was the big thing. People then just stopped paying the tax. So you're already seeing that, and you have the UTPs or whatnot, but it's already sitting there. But it doesn't fundamentally change these businesses. And ultimately that savings in tax, and this has been proven out in a myriad of industries, just gets passed to the consumer. And so I always tell
people, expect that if we get 280E reform, you probably see another leg down in cannabis pricing as everyone tries to pass that along.
Some of these markets that are more protected, like I don't know how much lower you can go in Oregon, because again, I don't think most of them are paying 280 anyway. But I think you'll see that pass to the customer. And then I always said, okay, and then the next big thing will be, 280 didn't save us, because I don't think that fundamentally changes the dynamic of most of these businesses. Because again, whether it's 12 months, 6 months, it's going to evaporate to the customer. Now we don't have interstate, and so we can't get scale. But I'd argue interstate runs into the same problem. Like, just because you have more weed, we're realizing this in Jersey, doesn't mean customers necessarily going to buy it. Like, you have to have brand, you have to have relationship, you have to have like presence when you go from, into these more restrictive environments. Like, they're just, brand is going to become more and more important, in my opinion, inside of this industry as it continues to mature. And just that loyalty. And it's one of the things we're investing in and thinking about heavily right now is how do we build that more. It just becomes more top of mind. We've got great quality product, great costs, now making sure the customer really appreciates the offering that we bring.
Going to Michigan, we talked a little bit about how you saw a rebound in the ramp and the yield and the A flower in Michigan. Can you share, you shared some of your thoughts. Are there any more thoughts specific to Michigan? I saw there was news this past quarter, TerrAscend's leaving. And when you look into their financials, they were losing like $3 or $4 million a quarter in Michigan. There's distress in Michigan. What are your overall thoughts of where Michigan is now in the cycle, or anything else to share about Michigan?
I think Michigan's finally hit the foundation level of maturity, and maturity is measured in phases, right? There's, ultimately, I think you get to wide distribution of supply. Fragmentation is the wrong word, but it's diversity of product offerings and brands. Like, there's not these like silos of, kind of constricted options. Like, if you want wine, you can buy it in Napa, you can buy it in the Okanagan Valley, you can go to the Willamette, like you can get wine all across, you can go to Italy, like wherever you want. Like, if you want wine, you can get it. A lot of states, you're restricted. Like, you can't get this product or that. But in Michigan, now you can get whatever you want. So fully mature, and now pricing's reflective of that. And I think it's the first thing. Michigan's a massive market, $3 billion, and I got a per capita bigger than any state in the US. So again, you saw a lot of entrants. But guess what you're seeing now? You're seeing all the distress. You're seeing all the companies that are going out of business or trying to sell. We get more inbound now with Josh just because he's so connected to that. But like, the amount of inbound we've seen coming out of Michigan recently has been kind of a lot. As people are seeing like just the challenge of operating in kind of that mature market. And that's from like smaller groups, it's retailers, it's, small kind of growers, processors. And then you see the other side of it, which is, the big companies are really struggling there too. Like Green Peak went into receivership. I think they released some of their project. PharmaCann is now in receivership. So they had the big LiveWell facility that they bought there that came offline. TerrAscend just exited. I don't know, you're kind of seeing it play out. This has been the thesis for a long time, that a lot of the way the companies are currently structured in our sector can't really compete in full mature market environments.
And that's part of what,
in Michigan. Yep.
Yeah, and that's part of the value of when someone like Jamie Mandola worked at Air Wellness and is incredibly well connected to the multi-state operator landscape, is basically communicating and saying, now that he's no longer with Air, hey, you need $1,000 flower to make money. That's why I'm so obsessed and so focused on what you're doing, because you're now operating in these hyper competitive states for about 50% less than that. And it's baffling to me in general why more people aren't interested in what you're doing. But I'm guessing they will as price compression continues and federal reform. It feels like will not only not change that, it may actually accelerate it if you have those price savings, those tax savings passed along to the customer. Let's move to New Jersey for a second. So we talked a little bit about the ramp and that it's taking longer than expected. Can you talk about the gradual turning on of phase 2 and why that makes sense? So just to rewind and summarize what we already discussed, we thought because the market was undersupplied, it turns out it's just a protected market with high price. Grown Rogue is going in, winning. I'm assuming you're basically selling out everything you're producing from phase 1. You're now slowly turning on phase 2, right? Can you talk about this process of turning on New Jersey to full capacity?
Again, like, it's gone slower than we expected, and I'm not going to apologize for the internal expectations, and we'll be a little more thoughtful around the external. But like, there's a real balance, and Josh and I have had a lot of discussions around, like, and you in particular, just, as you started, you get very excited, and one of the things that makes you so just fantastically amazing. But when you set high expectations, you force your teams and your businesses to operate at the highest level. And so, could we be better at the way we communicate? Sure, but it's gone slower than anticipated, and mostly it's around it's a controlled market environment. Josh has more experiences than Grown Rogue has. We've existed.
So let me pause just for a second. When you say controlled, can you explain that? Because it's actually really important.
Jersey. Yeah, Josh, you should talk about this because you'll probably articulate it better than me. Yeah, that would be a great one for you to answer more specific.
I mean, I usually use the term cartel, but we'll go to just there are a ton of shelf space reciprocity agreements that exist between the larger players in markets that, particularly when you go through a transition from a medical market to an adult use, and those incumbent medical players have stood up the most cultivation and they have stores. They move a bunch of product through their own stores. Those initially, if those stores get to turn on right away, they get to be the largest stores right out of the gate. And so you end up with a lot of shelf space reciprocity between the larger players. And so
can we pause just for a second? I just want to double click. I want to zoom in on what you're saying. It's a really important point. And what I have heard for inside is that, and a lot of this happens, I doubt a lot of MSO investors realize this, but at the end of it, there's a lot of, hey, you carry my product and I'll carry yours and we'll swap it. And there's a lot of weirdness that I've heard that happens at the end of the quarter where there's reciprocity. But can you zoom in on when you say shelf space reciprocity, what exactly that means? Company A does what to company B?
I'll give you an anecdote, and then people can go and vet this for themselves if they do shopping in any of the stores. And I really think if you rank order where this is most problematic for new players, it's probably Pennsylvania, Illinois, New Jersey have this dynamic in really strong form. And so, and I'm not going to comment on kind of the quarter end dynamic that might exist. A lot of companies go through stuff when it comes to how they close their books and what they're looking to have on the P&L versus their balance sheet, et cetera. But if you just looked at this in a vacuum, a lot of it ties to, if you were to go to a vertical store, they're often pushing their own product, and if they've got more cultivation capacity than their stores can push, which is typical in many of these environments now, then what will happen is you'll go into the store, the vertical product in that store will be the product that's discounted. And then you will see the other vertical operators have the rest of the shelf space for flower, for pre-rolls, for vape, whatever it may be. The larger categories are covered. And typically, and sometimes that product is discounted. But what usually happens is the vertical store moves the most, and discounts are a pretty big needle mover relative to the retail environment in cannabis generally. And so the discounts move a decent amount of your own product. And then if someone's coming in and they have the name, or they've acquired XYZ product before and they want to go to it, and it's coming from one of the other vertical players that has shelf space there, they're then able to maybe pay a little bit more because it's not discounted, but they're still adding it to their basket. And so what you have is you have a good chunk of the flower, vape, pre-roll in particular, the three biggest categories. You have a big chunk of that shelf space already spoken for in the highest volume stores. And what we see over time, and this is where being customer centric is one of the reasons that I'm on this Grown Rogue team, and what I really appreciate about what Obie's built and the team has built is over time that's a disservice to the customer in my opinion, but it is near term the most profitable thing one can do is structure those arrangements, protect that vertical profit stream, and navigate the business that way. And so you see that a lot if you shop in Jersey, if you shop in Illinois, if you shop in Pennsylvania in particular.
Gotcha.
Does that make sense?
Yes. And so what basically happens is I'm company A. I have giant cultivation. I have a number of stores. I'm going to sell my own company A's product. And then there's company B that's just like me. And the excess that I can't sell in my store, I'm selling in company B's store. And company B is doing the same thing with me. And company C, and there might be like 4 or 5, maybe 6 players that are all doing the same. And then what I've seen over time, and this is what killed, this is actually, I want to write a post about Air Wellness, because this is exactly what Air Wellness did, is eventually the customer wants the best product for the best price. And they don't want mediocre or inconsistent quality for a higher price. And eventually more stores open, there's more competition, prices fall, and then suddenly you can't sell your excess capacity. And that company A won't take as much company B product. Company B won't take as much company A product because they need the sales. And then it becomes this perpetuating cycle down. Is that the general sense of things, of how it starts out protected? And it may not be all at once, but it may be slowly melting.
Yeah, I think that's a pretty good description. And I'll say, like, across that mix, like, different companies participate in it differently in different degrees. I think a lot of the companies have gotten much better, both with their own internal products, so they're getting better. It's not and others have gotten better on the purchasing side. Like, we have very good relationships with a number of these companies at this point. They do want to serve the customer. It's just this balancing act that they have based upon the capacity they have. It's not irrational behavior, but it's not. I mean, you get put in this box where, particularly when you've got a healthy amount of debt on your balance sheet, where you are needing to maximize near-term profits, and it becomes a very rational approach. It just makes it harder for folks like us to get to market and get on shelves. But we get there.
And but you are,
Yes.
you are, right? And so you've now turned on phase 1. And I can tell just from Reddit reviews, store visits, etc., that you're doing quite well with where you are. It's just taken longer than expected to get here. And so now, Obie, can you talk about phase 2 and how that is? It just going to follow how phase 1 went?
Yeah. Sorry, just pushing out 3:00 because this is more important and I'm interested. It's before I get to finish, it's a very interesting dynamic in how it works in these markets. And again, there's just more control. And being early is really important in how you set up your foundation. And you're going to want to protect that. And so it's just been an interesting dynamic in Jersey. And going back to how we phase, I mean, this is, in hindsight, I mean, super smart on our perspective, because everyone was like, well, why don't you go faster in Jersey and build the whole thing at once and just go? It's going to be this massive barn burner. Like, it's really hard to start with 1,000 pounds a month in product. And we thought Jersey even would go faster. But we started with half phase, because you want to balance your supply with your consumer demand. So you don't end up with like this big working capital deficit. And so we're pretty much through, I'd say, we're about 500 pounds a month. I think, July was in that range. Like, there's going to be big months, small months, like, might flatline for a little bit, but generally we're getting close to where we are selling through what we're producing each month. Now, obviously we weren't selling that in month 1, 2, and 3. So there's some inventory, and we'll hopefully be able to continue to increase our sales each month as we're building out phase 2 to put more monthly production online. And then our goal of phase 2 is to just practically bring on, a room every month or 2, right? So we're in the final kind of stages of what phase 2A we're calling it would be, where we're going to actually build our veg room. We're using a flower room right now as an interim veg room that'll turn into a flower room. And then as we see the demand for our products continue to increase and we're getting the sell through, we'll turn the next one on. And we'll try and do this effectively one at a time until we're at full capacity, just because it costs money to grow the weed. As efficient as we are, it costs money. We don't want to sink that into inventory that's sitting on the shelf. We want to put that into the customer's hands, not only for monetization of the cash we put against it, but we want it to be fresh product for the customer. Like, no one wants aged product. And so we want to move that into the customer's hands as quickly as possible. And so right now our goal is to kind of be done with phase 2 construction by the end of Q1. We'll see how the market responds. Again, we're not going to rush it. Josh hit on the head. Like we're building what we consider a long-term business inside of this. And if it takes an extra 3 months, 6 months, like we got a 3, 5, 10-year plan in terms of where we want to be in the business we're trying to build. And we're not going to change those principles to satisfy like a, kind of an exterior demand on why we're not going fast enough or whatnot. Like we want to go as fast as we can, but we also want to maintain our discipline, because a lot of the companies that are having challenges, you brought up Air, and I mean, they're going through their stuff. They went too fast, over leveraged, overextended. And that can work. A lot of times it's a recipe for failure, and we don't want to do that.
Can you give an update on Illinois? And how has your experience with New Jersey? Josh, you mentioned Illinois is one of the protected or cartel markets. How does your experience in New Jersey inform just the timing on Illinois?
I think Illinois is still under construction, just albeit slower. Like we've slowed that down. Again, we have, I don't know, $10 million in the bank. We could accelerate that, but again, we're not in a rush to go turn something on and put stress on the business. Like if that happens in 26, middle, late, like again, we got a longer term view on it. I think the beauty of where we're going in a state like Illinois is the learnings from New Jersey are going to be very helpful. We confirm that the phased approach makes a lot of sense. You're not going to walk into these markets and just be like, hey, Grown Rogue's here, buy all of our weed. Like you're going to have to earn it. And so phasing it in is going to make a lot of sense. 2, a lot of the relationships we're building in New Jersey have presence in Illinois. And so we'll be able to translate those, because we are a great partner. We have great product, great price, great service. Our team's super professional. We support the market. Like, the bigger groups in New Jersey love working with us. We expect that to translate. The other 2 things that we will deliver in a more effective manner is we were kind of in a rush to launch Jersey. We were like, again, back to the undersupplied thought, anything will work. Let's just get product. Our genetic planning needs to be tighter so that our product offerings are super tight. We came with what I would say 60% genetic platform that we'd like to have. And we won't repeat that same mistake in New Jersey or in Illinois, because we're going to know the competitive landscape sits there. Like we have to bring our A game. And then the other thing we didn't do in Jersey that we would definitely have is, we need to have our full brand suite, right? That'll be really important. So when we launched in Jersey, we only launched with 2 of our brands, kind of our premium and our standard. We did not have our like kind of, bargain, kind of call it bottom shelf, call it your, bronze tier available. And that's an important part of these markets. Like you need to be able to have a place for more price competitive offerings, stuff where you might want to stick, like a Port Harvest or something like that, which happens even to great growers. And so we'll be taking a lot of learnings to Illinois, and attacking that market in a more informed way based upon the learnings from New Jersey.
Going to Minnesota, your director of cultivation won a license, if I understand correctly. Can you talk about just the opportunity in Minnesota and the regulatory hurdles? Because I guess it's a little uncertain when the actual market will launch. And just love your thoughts on Minnesota and just how you think about that market.
Yeah, Josh, you want to go first on that one, and I'll follow up, or you want me to go first? You follow up.
Yeah, I'm happy to jump in. It's a market I've got a little familiarity with.
Yeah, exactly.
I mean, I think, first of all, we're evaluating real estate currently. We think we've got a pretty good playbook there. Should we find what we're looking for to get to market pretty efficiently. So, we're not at the point where we've said, this is for sure happening, but it's definitely as intriguing a market as one could draw up for what our skill set is, I think. Normally we talk about a 50,000 square foot box and getting to that 1,000 pounds a month for us, particularly for a state that's got, I think Minnesota's 5.5 million people. because of how the dynamics work in Minnesota, our license allows up to 30,000 square feet, or the license that our director of cultivation has allows up to 30,000 square feet of canopy. We think while we will still take a phased approach if we proceed with this. We think that's a state that we might get a little bit bigger than we normally would, because we think it's going to be relatively capital constrained and relatively indoor flower constrained for quite some time. The two incumbents who we think have a pretty nice early advantage, which is GTI and Vireo, they're both capped on the adult use side at that same 30,000 square feet of canopy. Depending on how much medical canopy they have, there's kind of some weird nuances to how the regulatory environment's unfolding there. The market is, on paper, turning on right now. They're allowing retailers to get open. They just don't have any product because they've not yet allowed the dual license structure for GTI and Vireo to take effect. But I think both of them have come out recently suggesting that that's going to happen soon. And you have probably, there are certain states that have a little bit more of a tribal Native American dynamic in play. I think Minnesota has that. That seems to be where some of the supply comes from. But thus far, it doesn't appear to be what I consider competitive supply with respect to how we'd hit the market. So we think that's a market that's got a really nice runway for the foreseeable future, and is really, if you think about it from a prioritization standpoint, you heard Obie talk about Illinois, and while we're excited about what we can do in Illinois, Minnesota, if it comes together, I think you'd see a pretty aggressive push on our part because of that market dynamic that exists.
And so when you think about right now, there's only two medical operators. They're both capped at 30,000 each. That's 60,000. What should the total roughly, have you done any analysis on what the size of a comparable market would be in terms of indoor cultivation capacity for 5 million people?
I've got to go back into my annals and try to remember this. I don't have it top of mind. And in part gets a mix because you can do outdoor. But
it's Minnesota, so you might have 2 months, 3 months.
True, but what's interesting about Minnesota is that, as you're aware, given some of your other investments, Minnesota is the most advanced hemp beverage market in the country.
No, that's right. I'm very well
aware. For
that,
you have a pretty significant hemp processing and hemp cultivation infrastructure already in place. So I do know, just anecdotally, I know a number of folks that are actually planting some outdoor crops and working towards outdoor in Minnesota. So I think the low end of the market is going to get covered reasonably well before long, between not reasonably well being called a limited amount. But the ballpark answer to your question is several 100,000 square feet of canopy would be required normally for 5.5 million people. And if the two are capped and there's no other licenses, you're going to have another situation of like New Jersey or one of these other markets. It's just going to be very, very challenging. And the benefit of Minnesota, from what I understand, you're going to have lots of dispensaries and you're going to have a lot of independent dispensaries. So in a weird way, and this is why I've actually, if anyone's followed me, I'm quite bullish on Vireo and have been for a while, because you might have a situation where the indoor capacity is dramatically constrained, but you have lots of points of distribution. And so it's a very unique dynamic, where normally you just have a captive market like in Illinois or New Jersey. It's constrained and it's captive, but you might actually have lots of customers with few options. We like how it's mapping out. So agreed.
Now, you've talked about this before, and we were talking about this before we started recording. You mentioned on the call and in the press release about distressed opportunities. To me, this is one of the most exciting things that could come from Grown Rogue, because when I see what Grown Rogue has perfected is a process, it is a system, it is a culture that you can reproduce over and over and over again. Now, to date, it's been Grown Rogue building, entering a new market, building, but with distressed opportunities, there's an opportunity to go faster, to step into someone else's facility. Maybe you got to do some fixing to it to get it to how Grown Rogue operates. But there, as you were already mentioning, is tremendous distress in Michigan. There's tremendous distress in multiple markets. unfortunately, 280E is not going to save these people, um, or any of them. I'm curious of just zooming in more. What does it look like in the distressed world? What are the conversations, and um, just your confidence level on what kind of opportunities Grown Rogue may or may not be able to see, being fully cognizant that I have been overly bullish before.
Yeah, I mean, I think I'll start with the challenge. The challenge of distress and spending time with distress it's a pretty wide funnel. There's quite a bit of distress in the industry, and we'll get to the catalyst for that in a minute. But I think a lot of them are fairly obvious for those that will pay attention to this. But because there are multiple parties, not just potential acquirers, but multiple parties that have an interest in the existing distress, whether that's lender, landlord, executives, etc., there are, the ability to get things closed has an unpredictability to it. There's a lack of control of that process to a degree, from a timeline standpoint. So it's really difficult to be, kind of titrate confidence and timing as to what you're going to end up being successful with. But the funnel's big. And so I think one of the advantages that I have with my history in the industry, and then also the relationships that we've built on the ground, is just the ability to take that funnel and narrow it down to what we care the most about and what we'd be most interested in. And I think there's a couple of dynamics that come to play that are really helpful. One is we are big on culture. And for us, a big part of this is where can we also augment our talent base, and/or augment being find people that are already wired like Grown Rogue and just fit right in, and/or even bring some additional skills, talents to Grown Rogue over time that can help us augment what we're doing, because some of the opportunities we're looking at are vertical, and then within that, being flower forward as we are, where are the situations that allow us to step in and improve flower and improve this flower production in particular, so that we can improve, if it is vertical or if it's got manufactured products, we can improve every piece of the supply chain as we go and come back to the return hurdles that we're after. So, we articulated on the conference call, and I think our newer deck articulates this as well, that for us, kind of our core underwriting criteria is that for every dollar we would spend from an invested capital standpoint, that we can drive 75 cents of sustainable EBITDA. And my view on that is there are situations that might have us take on a little bit more bandwidth, in which case we might even push that to a dollar for dollar. If we're going to be, boy, this one's going to be a heavy lift, let's make sure we've got the returns. And then, as wearing my old investment analyst hat, like if we get 50 cents for every dollar we spend, that's just a phenomenal return on capital. And so the opportunities, I refer to it as target rich. There's a lot out there. It's fairly target rich. And frequently the combination of bad leases and, I'll call it, relatively suboptimal operations, not great operating practices, fair room, and it's the cultivation assets that are frequently the albatross of a portfolio. If you talk to a number of the larger players in the industry right now, we talked about this actually when we were talking a little bit about the reciprocity side of the equation. If you have too much wholesale product, you're trying to add more doors. And so we see a lot of folks buying retail. Retail assets are much easier to move. Cultivation assets, they're often the albatross in a transaction. And so by and large, what's kind of fun about this for me is we're spending time really hunting in the part of the industry that we don't have as much competition. There aren't a lot of people looking for what we're looking for. And we have a capability set that I think there are others that I'd put in our category that are, have their own strengths within flower production, mostly come from mature markets. But there aren't a lot of them. And there aren't many that come with my background, relative to what we can pursue and where we go and how we pull the team together. And so I think we're in a pretty unique position to capitalize on this. I think I'll be disappointed if we've not done something more material by the first half of next year. To put some scale to it, we're looking at things that might be a small grow with a couple of stores, all the way to grows that are a little, quite a bit larger than what we've operated historically, that we can step into, and again, we're very sensitive to balance sheet risk without taking, bet the company type risks in terms of what scale we're talking about. So, what we actually get across the finish line remains to be seen, but really, really comfortable and excited about what we're looking at.
And that's part of the opportunity of just when you're kind of forged in Oregon or Michigan, you're operating at such a low, you figure it out ways to be as efficient, hyper efficient as possible, that you can take that to existing facilities and do the grown rogue way and just generate possibly very, very attractive returns on capital.
And we both got to live this. I mean, Obie and I being both here, we got to live this when I was CEO at Vireo, and we had Grown Rogue as an advisor, and very engaged advisor, and it wasn't in stellar indoor infrastructure. It was in a pretty junky greenhouse in Maryland, and just taking kind of poor practices to mediocre quality and up, just that massive productivity enhancement that happened in the cultivation facility and throughput drove material cash flow improvement in the business compared to what it would have kind of just naturally gotten with the increase from adult use. And we got to live it real time, and you can just see how productivity drops dollars to the bottom line to a degree that I think most folks in the industry still don't really truly appreciate or understand, because the pricing's been the driver of that historically, not productivity. Everybody's benefited from these high pricing environments and dropped a bunch to the bottom line. And then as that dissipates, it kind of goes the other direction. What I see are these opportunities now in, I'll call it maturing markets, where we can step in and provide really meaningful productivity enhancements through culture and SOPs, and empower local market decision making by playing the local hustle game a little bit better. And I'm really excited about it.
Gotcha. Let's talk capital needs. When we think about the opportunity set, you have, phase 2, New Jersey, you have Minnesota, you have Illinois, there's distressed, your phone's ringing off the hook for distressed. There's lots of opportunity for growth. How are you going to fund it? And how should we think about, and then maybe you could also talk about the money that you have tied up in Abco in New Jersey, which is a pretty significant amount, and how that might fund. I'm just curious of how you think about funding all these potential growth opportunities.
Yeah, I'll start at the high level at Obie. You can fill in. I mean, I think that it's really a combination. So we've got, at this point, a good lending relationship at the commercial bank side. That the commercial bank we've at least had conversations around what we're looking at from a distress standpoint at a high level. And there's a willingness to stand behind and to provide some lending support if we're stepping into real EBITDA, real cash flow. And so, the first layer is, with respect to distress and or existing operations would be, is there a little, and we're pretty sensitive to how much balance sheet risk we're going to take, but is there a little bit of lending that we can do at very attractive terms that can support kind of a baseline for small, modest sized acquisitions? So that ties into distress. When we're talking about the new builds, it's really a combination for us of existing balance sheet, cash produced. At this point, Jersey is becoming the most meaningful of the cash flow production. And again, it doesn't show up in our operating cash flow, but it is, it's inflected to being cash flow positive on the ground. And so that dynamic mixed with, we've had supportive equity shareholders. You're included in that mix. Wearing my Bengal hat briefly, I'm included in that mix. We think for the right things, there is equity or equity-like capital available. And so we're pretty comfortable, confident that for the right situations, we'll have access to capital to do what we need to get done. If something more meaningful comes along on the distress side, we've our general network and relationships have also expressed at least an interest in having a look at those things, and I'm pretty confident that the bigger ones, if we're interested in the bigger ones from a risk standpoint, they'll make a lot of sense to capital partners. And so we feel pretty good about that dynamic of, hey, now we've got something particularly juicy. Here's what it is. Here's what we need. That audience is out there for us, given the capability set we have.
No, that's great. Couple more questions. Let's talk about hemp. I know it's a big source of topic. I'm an investor in about 10 hemp beverage companies. I know Glasshouse has talked about hemp. Is there an opportunity for Grown Rogue to participate in somehow in hemp? Or, when I think about eventually the jailbreak, and I'll combine these last two because it's related to interstate commerce, is that right now hemp is being sent across state lines. And because it's not, on the it's not a controlled substance. And so, one of the opportunities that I see for Grown Rogue, and it's the same opportunity for Glasshouse, is if you're the low cost producer and you're kind of trapped in this hyper competitive market, what would happen if you could send your products nationally? It's becomes very, very attractive. Um, and and so I'm just curious of how you guys see hemp, how you think about interstate commerce and the potential, if we're on the cusp of reform, of how you think about this long term.
I mean, I've probably done more proactive thinking about this recently than Obie, but we've been kind of back and forth with a lot of dialogue around it in the last few months in particular. And I think that the view that I have at this point is that it behooves us to do more work on this front, if for no other reason than as an insurance policy, in case this becomes the backdoor to full legalization. And it speaks directly to what you were just referencing, Aaron, which is there already is a direct to consumer channel for hemp derived THCA flower. And so, we're seeing the rails in hemp get established. I don't think ultimately, if you had full legalization, that smoke shops would be the natural place for distribution. But that dynamic is one we need to better understand, and we're doing research around. I do think there might be ways for us to participate without taking balance sheet risk and without taking excess company risk. But that's I'll put that in the under evaluation, but very interested because to me, whether it's hemp, whether it's marijuana, like being a low cost quality provider of indoor flower, it's a product that people want. And to me, however distribution gets solved in the long term, if we stay true to that core competency and can do that at reasonable scale, we will be successful. And understanding the hemp channel and knowing that it's possible the genie gets put back in the bottle, it's possible that it doesn't. There's a whole host of potential outcomes still to be determined based upon how both regulatory environments work, hemp and more traditional marijuana. So we are paying more attention. I don't think you'll see us make any big capital bets, but I do think you'll see us do work on it, and we might have something more material to say that out on that in the next 3 to 6 months. If something comes to fruition that seems to make sense to us, but we want to understand it.
Yeah, I echo Josh's input on that and kind of summary. I don't, at this point, I don't think you can help but look at it. I think there's an opportunity that sits there. I think there's some regulatory kind of complexity that needs to be figured out. But like anything, it's early in how that market is playing out. And if we've seen anything across this sector, and it holds true in hemp, like we've seen in kind of the regulated cannabis markets, high quality at the right price wins. And what's most appealing to me is kind of this direct to consumer opportunity that kind of bypasses the need for a retailer to kind of be your end kind of facing with the customer. And so it's got a lot of excitement there. And so again, we're not taking a huge bet on this. And I actually don't think something like this requires, big kind of financial commitment. But I'd be surprised if we didn't have some, not exposure is the wrong word, but starting to figure out like how do we balance that as we look at back to interstate and how the regulatory is shifting, like to make sure that we're prepared, as I think we're going to see quite a bit of regulatory change, over the coming, years, whether it's deschedule, reschedule, but there's going to be some shifts coming, and I think hemp is going to have a seat at that table, and how do we participate and be prepared for that is going to be important.
Aaron, I don't
Great.
know about the first time you visited Medford, and or at least you might have been to Medford before you visited Grown Rogue, but I had not. So my first visit to Medford to visit with Obie and team, and we're walking through outdoor farm, and Obie's explaining to me how he's ready for interstate commerce. And I was like, yes, but let's spend more time talking about your indoor grow, please. Like, I really want to, like, I know the indoor business better. I want to understand how these indoor economics work. Like, let's dig in there, because I think you might have
The-
something. I think you might
I
have
was
something on the indoor side here.
I've just had to slow down for Josh. I was like, Josh, the big picture's coming. Like, this is where the industry is, but okay, I understand. We'll do this little kind of sideways shot with this indoor business, but whatever. Like, but not circling. I mean, we do live in an area where there is high quality, low cost, and we talk about costs for indoor. And again, we don't do much on our outdoor business. We think that's a pure interstate commerce play. It's not something we can translate to new markets. There's other places people are going outdoor, but you want to talk about cost efficiency. It's insane, the costs that we can get to with outdoor production.
Well, there's an opportunity that if there ever is interstate commerce, that you could probably consolidate a lot of outdoor acreage, and not only, but now you have kind of regional hubs of indoor that are directly selling to customers, branded products, packaged, that you're used to selling to dispensaries that can sell anywhere. There's no reason why Oregon couldn't sell to, if there's interstate commerce, to Pennsylvania or Texas or Florida, Michigan. And if you're able to acquire more distress, you just have more indoor, super low cost indoor quality flower. And I think you're primed actually for interstate commerce. And I'm very happy to hear you're experimenting with hemp, because I think it's a preview. Whether it's actually hemp, that's the pathway, or something else, there's going to be interstate commerce.
I think agreed, and I can't stress enough the D2C component of that, to start building the relationship with the customers. I think not only helps if that becomes the venue for how this industry plays out in the future, but also for how the business, it's playing out now. Like, those customers who get exposed to the brand, get exposed to the quality, or that's going to translate to just better information and communication around our company and what we're putting out there. And so that's the most exciting part of it for me.
Well, great. Well, Josh and Obie, thank you so much. I really appreciate it. This has been great.
Thank you, Aaron.
Thanks, Aaron. Yep, really appreciate it.